Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, March 8th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. We've got futures trying to turn back up a little bit here this morning. Of course, futures have just been moving all over the place from one night to the next morning. So it's hard to say. We still got a couple hours before the market opens. But right now, Dow futures up a little over 200 points. The S&P 500 up 31 and NASDAQ futures up 80. So it does look like we'll get off to a decent start. Overnight, crude oil up another $3.30, currently at 122.70 per barrel. 10-year Treasury yield up 10 basis points. 1.85%. So clearly we've got some issues that the market's still going to have to deal with. Gold up $19 an ounce earlier this quarter. I think gold was down around 1,800, and I predicted this quarter we'd see 2,000. Well, it's 2015. So that is one prediction that has hit. Other commodities doing well today as well. We've got silver up about 2.7%, copper up about 0.7%, platinum, palladium higher. It's just been kind of a crazy, volatile year so far, and I don't think it's going to end anytime soon. Cryptos have been all over the place. Do see cryptos a little bit higher this morning. Bitcoin up about 3.6%, Ethereum up 4.6%. So anyway, a lot of things going on there, but let's take a look at today's agenda, some of the things we're going to talk about. Start off with the daily market recap, as I always do. We'll take a look at Monday's action. Talking technically, bear market drivers. I'm going to go through and show you a couple of charts that I'm watching, some things to maybe keep an eye on, think about as we work our way through this, what I believe is a cyclical bear market. Then earnings spotlight, and we'll wrap up the show with the three you must see. Before we get into any of that, though, I always like to welcome our new listeners and viewers. If you go to earningsbeats.com and scroll down, we do offer a free newsletter. I always just like to point that out for anyone who wants to learn a little bit more about us. It's just one way that we give back to our community. It is completely free. There's no credit card required. You can unsubscribe at any time. All it takes is a name and an email address. Hit that subscribe button. It's a 2-paragraph, 1-chart newsletter. So it's a very quick read, probably start to finish 3 to 5 minutes. That's maybe even if you sit there and study it a little bit. So it's not going to take much time. Like I said, coming out Mondays, Wednesdays, and Fridays. And normally it's out around 8:30 in the morning Eastern, so about an hour before the market opens. Anyhow, just tell you a little bit more about some of the things that we look at and the way I approach the stock market. I think, even if it's not something that necessarily agrees with your strategy and your own style, there might be some things you might pick up from it that could help in your trading as you go forward. So anyway, check that out. Make sure you go over to earningsbeats.com. All right, the daily market recap from Monday. Just another ugly day. Dow Jones down 797 points. S&P 500 down 127. NASDAQ down 482. So as bad as the Dow and the S&P were, NASDAQ was down even worse, or down even more on a relative basis, down 3.62%. Mid caps down 3.76%. Small caps down 2.25%. Just really ugly across the board. Looking at sectors, energy strong, up about 1.5%. Utilities also strong, up 1.3%, breaking out to a new high on Monday. So utilities, just 8 trading days ago, we were probably at a 4-month low on utilities. And now after 8 trading days, we're at a 52-week high. I mean, that's the kind of volatility. It's not just impacting these high flying growth stocks. It's everything across the market that has just been crazy volatile. Discretionary stocks down almost 5%. So if you thought the worst was over before yesterday, you were wrong, because discretionary stocks had one of the worst days that we've seen in quite some time. Discretionary down almost 5%. Technology down 3.66%. Financials 3.65%. I mean, these are 3 of your aggressive groups getting hit really hard to the downside. Many of my sustainability ratios that I watch, all turning down with the market yesterday. I mean, nothing is giving me signs of a bottom at this point. So I would really continue to be very careful. That's what I've been preaching in 2022. I started this back in December of last year and haven't let up, even through the brief rallies. I said, for the most part, I felt like those were fake, head fakes, and that we were going back lower. I'm sticking with my call. I think 3,800 is a minimum target to the downside on the S&P. Wouldn't be surprised if we see 35, 3,600. I mean, maybe we go down lower than that, but I believe if we get down into that 35 to 3,800 level, that's where I'd probably be very careful on the short side and begin thinking about moving back toward the long side, even if there's a little bit more downside in the near term. I still believe 35 to 3,800 is a very, very strong entry point into the S&P 500, based on my belief that this is a cyclical bear market. Some might argue it's secular. I don't believe that. We will see, but I believe we are going to bottom probably. I wrote something just recently where I was saying March might be worse than what we've seen in January and February. And you kind of saw a little bit of that yesterday. Don't be surprised. We've already got the VIX up in the mid 30s. When you're up in the mid 30s, if this market breaks down below these recent lows, you could see a pretty big down day. I mean, I wouldn't be surprised to see the Dow down 1,000, 1,500 in a day. NASDAQ, we just had 480 yesterday. I mean, what's another 400 or 500? Just be careful. I really think that we've got more downside action here. 10-year Treasury yield. Well, one of the things that's a problem this week is up until Thursday, we don't have any economic reports coming out, none of significance anyway. So the market is left to deal with not a whole lot of earnings coming out and very little economic news. The market is left to deal with the headlines, which are all horrible, and the technicals, which are all horrible. So there's really not a whole lot the market has to kind of, there's no footing. The market just doesn't seem to have any footing, anywhere to turn outside of maybe the VIX being high. And so sometimes, we get reversals off of that. But the equity only put call ratio normally coincides with that high fear in the VIX. The elevated VIX normally, you get a 5-day elevated reading on the equity only put call ratio. We're not there on the put call ratio. I mean, too many people still believe, especially in the options world, that we can't go lower, that we have to go back to the upside. And that's scary. Anyhow, I could go on and on, but big problem this week is there's not really much in terms of economic reports. And then when we do get economic reports, they're not going to be good ones. We got on Thursday, the February CPI, core CPI coming out. The expectation on the headline CPI number is a rise of 0.7%. If we strip out the energy and food areas, core CPI expected to rise 0.5%. That's just going to give more and more, I don't even know what the word is, but bait, something like that. It's going to give the media a lot more to work with in terms of headlines to scare everyone. The inflation numbers are going to be very, very high when they come in on Thursday, and expect 42-year high in inflation. I mean, expect those headlines because their inflation's going up. And I've been talking about this for the last 3 months, pointed out how the inflation's calculated, talked about how these 2022 readings of inflation were going to be replacing the year ago levels, which were very, very minor increases. And now we've got these big increases, and that's all factoring in to these headline numbers that the media is just having a field day with. So just understand that we got more of that coming up starting on Thursday. Got an interesting chart I'm going to show you about the dates of these inflation reports coming out. And then on Friday, we've got March consumer sentiment. This is something that's been dropping every month, consumer sentiment. And that is a sign to me of an impending recession. When consumer sentiment keeps dropping, February was 62.8. On Friday, we're expecting March to come in at 61.7. And in that continuing drop, it may come in even lower with everything that's going on right now. We'll see. I don't want to get too far ahead of myself, but yeah, probably not going to get any great reports. So we're left to deal with all of this week. And by the way, March 7th to March 10th, the 7th to the 10th of every calendar month since 1950 has produced negative annualized returns. This is one of the worst times of the calendar month to be invested. Normally we have money flows come in at the beginning of the month. We have a nice run up the first week. Well, then we tend to see profit taking in the second week. So there's no new money flow coming in at this point. And so we've got historical tendencies that are bearish. So just, keep all this in mind. Don't be surprised if we do continue to struggle. And I do think March is not going to be a pretty month. I've said that recently, and I'm sticking with it. I think it could be worse in January and February, maybe combined. All right, let's see. What else do we have? How about the S&P 500? So we jump into talking technically here. What I wanted to point out from that high at the beginning of January on the S&P 500 to where we closed yesterday, it's about 13% drop. And I've had questions. I had questions. One question came in from a member a few days ago. I saw it. I just haven't had time to respond to it. But after that big surge here at the end of February, I don't know if it was a question as much as it was a comment, but basically it was, how could we possibly be in a bear market if we've got this huge Russian-Ukrainian conflict and the market is soaring? And that was in the midst of this big move back to the upside. Well, the anatomy of a cyclical bear market, which I had a session, an educational session for our members at Earnings Beats back on Saturday, February 12th. I pointed out how these cyclical bear markets work. Many times, every cyclical bear market has had these periods where you think everything's good again. You get these rallies that come back up 4, 6, 8, 10% in just a couple of trading days. You can see that at the end of January. You could see it again at the end of February. These are typical in a bear market. And then you roll over and you go to new lows. And that, I believe, is what we're in process of doing right now. So be careful about, that's what market makers do, unfortunately, is when you get into these volatile periods, all of a sudden you have these big moves to the upside and you think everything's good. We've bottomed finally. Why? Because when we have these little pullbacks back in May of 2021, we rally off of them. The pullback in June, we rally off of it. July, we rally off of it. This was a little steeper in September, but we rally off of it. So you get into this mindset every time that the market starts to bounce, that's it. We're not going back down again. Cyclical bear markets are different. And I've been talking about this since the end of December. So this isn't something I'm just now bringing up. This is something I think everybody really needs to be aware of. And unfortunately, when we do sell off and market makers go on vacation, what I like to call go on vacation, their job is to provide liquidity. But look at the volume picking up and look at the selling. Yesterday's volume was one of the heaviest we've seen. And look at that selling from start to finish. It was selling all day long. That is distribution. Short term, that was distribution. And you can see the AD line actually turned down with it, even though we're still up near 52-week high on the AD line. I think eventually that will help us. But yesterday it was pure distribution, selling all day long. If market makers aren't supporting prices and we break this low right here on the S&P 500, you could see very, very rapid acceleration of selling. I mean, like a big gap down followed by another one of these big red candles. We could see the VIX, normally upper 30s, you start looking for bottoms, and it could bottom there. I wouldn't be surprised, though, with the CPCE, the equity only put call ratio, where it is right now. I wouldn't be surprised to see this drop, S&P 500 drop, break down, and the VIX shoot up to maybe 45 or 50. I wouldn't be surprised. Now, at the end of all this, I think we're going to print a bottom that's going to be a pretty significant bottom. So that's the good news. So if you're sitting out, and I know we've got a lot of members at Earnings Beats that are sitting this one out. I've gotten so many emails from members, thanking us at Earnings Beats for a lot of the warnings that we had been providing at the end of December and throughout January and February. I mean, you know, it never is a guarantee that we're going lower, but when you start seeing warning signs, I think it always makes sense to heed those warning signs. And so anyway, if you have been sitting out, you've been patient, continue to be patient. We're not there yet. Now that we have broken down and that we're in this downtrend, there's no doubt in my mind we're getting to 3,800. I mean, obviously there's no guarantees, but I believe pretty strongly at this point, now that we've rolled over, failed at the 20, you know, volume picking back up again, these red filled candles, it certainly looks like, and all of my sustainability ratios, by the way, are going down with the market. Nothing is giving me any kind of positive divergence. So I think we go lower. All right. Industry summary is part of this talking technically segment. I just wanted to point out, this is the year to date. So I just went in, pulled up the industry summary, which you can get on your dashboard. Let me show you how you get to all this if you haven't done this before. Pretty cool. StockCharts gives you so many great features. From your dashboard, under member tools, just scroll down, and under summary pages right here, you'll see industry summary. You click on that, and I like to look in the table view versus the chart view. That's something I've just been used to over the years. Anyway, just change the period from intraday to whatever you want, but I did year to date, so that you can see in 2022 how many groups. Look at the consumer discretionary group. I mean, how can you feel good about the stock market when consumer discretionary is this ugly? 2/3 of our GDP is consumer spending. What is this telling us? It's telling me we've got a recession coming. Toys, congratulations. There you go. What are there? 21, 20, what is it? 21, 5, 8, 10, 15, 15. Yeah, 21 industry groups. Toys is flat. Business training and employment agencies this year down almost 13%. By the way, there's your S&P 500. I showed you that chart. S&P down 13%, basically year to date since that high at the beginning of January. Almost every industry group within consumer discretionary is underperforming the S&P 500. Again, how can you be bullish? How can you think bullishly when these groups are leading the market to the downside? Not good. Now, what's been leading? Well, you got a couple consumer staples groups. You got energy, obviously. Energy's been absolutely on fire. A couple financial groups. I've talked about insurance lately. Insurance has been fairly strong. Reinsurance has been very strong, up 7% year to date. Some of healthcare is held up. I mean, relative to the S&P, which is down 13%, healthcare has done well. And I've talked sometimes about how, you know, you might see areas outperform the S&P 500, but still lose money. Here you go. Healthcare. Yeah, these have everything except biotechs have outperformed the S&P 500, but you're still losing money. I mean, it still doesn't feel good. Now, in industrials, defense, marine transportation, you got a couple of good groups there. Railroads actually breaking into positive territory. Aerospace doing better. But look, you still got a ton of areas that are down quite a bit more than the S&P 500, including airlines and transportation services. Materials, little hit or miss action here, but aluminum, gold mining. I've been talking about gold for a while now. I still like gold. I think it goes higher. I would be taking profits into this because as the fear ramps up, gold tends to do extremely well, but we're not going to always have this fear. The fear will start to subside at some point, and gold will probably pull back as a result. So I think it's good to use all of this strength to just slowly be working your way out of gold. That's what I've been doing. Real estate, yeah, everything's down, mostly better than the S&P 500. So that's a defensive group. Then technology. I mean, semiconductors, 21%, software, 19%. These were two major leaders in the secular bull market advances that we've seen over the last 8 or 9 years. They are performing very poorly right now. Anyway, lots going on there. I saw this headline over at CNBC, so I just thought I'd pull this up. Several Wall Street strategists cut U.S. stock outlook, with Ed Yardeni seeing S&P 500 drop to 4,000. I mean, I wanted to give him a golf clap. You know, 4,800 we started the year. We're at 4,200 now. And now we're seeing the drop to 4,000. That's quite the bold call there. Anyway, you know, I can't read this stuff. I can't even begin to read stuff like this. I mean, it's just, I mean, is that a headline? And by the way, this is part of the pro service. You can pay for this if you want. I'll just leave it there. Actually, I'm going to come back to that. I want to do one thing now. I want to show you bear market drivers. And so bear with me a second. I'm going to switch out my screen and bring up a different screen here. Couldn't get it in the other account. I have another StockCharts account where I have a lot of these charts. I just want to go through and show you a couple of things here. Let's start first with the NASDAQ 100 chart. This is an hourly chart that goes back the last 6 months. So it's a little bit busy, but just follow along here. You can see the channel, and I'm going to talk about this on a different chart in a minute, but we're in a channel to the downside. These 3 blue arrows that I've drawn in here, showing you the NDX, where we were, these are marking the blue dotted vertical lines, which mark the dates when the CPI reports have come out. Look at where the NASDAQ 100 was when the report came out. Here we dropped almost 1,000 points in a week. Here we dropped 2,000 points in about 10 days. And here we dropped close to 2,000 points in about 10 days, maybe close to 2 weeks. My point is, when this report has come out the last 3 months, the stock market has sold off. Now, we're already selling off, so maybe that will soften the blow a little bit, but this is not going to be a good report, and the market does not like hearing about this inflation. The red lines are when we had Fed meeting dates. So you can come back in and look at this later. I mean, I don't see nearly the correlation. I mean, here we had a drop. Here we are in the middle of a drop. Here we went up, or excuse me, here we had a drop. There was one of them on here with the red line that I saw. Oh, right here, we had a quick little drop. Then we had a nice rally after that one. So, I mean, we'll see what happens. I think the Fed's going to screw up. You know, that's what I've been talking about and been on record. So I'm just going to leave it at that. Just know that this Thursday is the next CPI report. And you can see the stock market has not liked it. So if we do get a little bit of a bounce over the next couple of days, really be careful on Thursday when we get this report out. All right, next chart. This was the channel I wanted to show you. And now this is also an hourly chart, but it only goes back the last couple of months, 2 or 3 months. And you can see that the tops, this was a chart that I sent to our members the other day when we were topping. We may have just pulled back a little bit, but this was after we had hit this trend line, this channel resistance. And so look at what's happened. I mean, we've seen steady selling ever since. When we hit it before, selling. Of course, here's where we started the selling. You've got to pay attention to this channel until it breaks. And the other thing that I had pointed out was when we hit this channel resistance, we actually had the first negative divergence we've seen in the last 3 months. And the reason we haven't seen any negative divergences is because we don't have strength long enough to even print a negative divergence. We've had barely enough strength to get into positive territory on the hourly PPO. So when we saw that negative divergence right at resistance, if you're going to short, that's the time you want to short. And that's what I talked about at the anatomy of a cyclical bear market event that we had in February. How important patience was during a cyclical bear market, because you do get rallies from time to time. You don't want to chase the moves to the downside. If you say, oh my gosh, it's just so ugly, I'm going to short it. Well, then you go through a period of a week or 10 days where you get absolutely killed. I mean, this was 1,700 points back to the upside. This right here was 1,300 points back to the upside. If you're short at the wrong time, you can get absolutely killed. You've got to be patient and wait for your opportunities. Anyway, I wanted to show that. Another big problem. This is, you know, I talk about sustainability ratios. When the market's going up, I love to see the QQQ outperforming the spider. That's telling me the NASDAQ 100 is outperforming the S&P 500. That tells me aggressive stocks are in the spotlight. It's a risk on type of mentality. That's what drives the market higher. Well, guess what? We now have confirmation of a risk off mentality, which is what drives the stock market lower. I mean, if you go back and you look at the big declines, the pandemic was a little bit different. Many of those technology companies did really well. But normally, I mean, if you look at the bear market, the last cyclical bear market that we had, well, technically, I guess it was the pandemic, but a normal cyclical bear market, one that lasts about 90 days, there it was, 2018. And look at the breakdown here in the QQQ versus spider, and we're seeing it again. This is a sign that this move right now is sustainable to the downside. So I think you got to be very careful. Last thing I want to talk about for the bear market drivers, everyone's talking about crude oil. I mean, crude oil is going crazy. I want to just, for precedence sake, this is another thing I provided to our earnings beats members just recently. Let's go back and look at 1990 and 1991. Crude oil went up from under $17 a barrel to over $40 a barrel. That was a 147% increase, while the stock market was getting hammered during the Persian Gulf War. But once we topped in oil, we also bottomed in the stock market. And what I'm just going to warn you about right now, yeah, crude oil prices going up, energy stocks are absolutely flying. When crude oil tops, and it will top, this is not sustainable. It might go to $160 or $170 a barrel first. When it tops, it's going to come back down, and that is going to help relieve a lot of the inflationary pressures. And I think I think we're going to have something very similar to what we saw in 1991. This is what it looks like right now. So here's your S&P 500 breaking down. Here's your crude oil prices absolutely skyrocketing. But if we go all the way back to where they had bottomed prior to this, you can see they've gone up about 82%. Another $50 or so would take us to 170, and that would be similar to what we saw back in 1991. Anyway, I thought this was a really interesting chart. Just be careful as oil prices go up. That's more inflationary pressure. It's also one more thing to drive us into a recession. So be careful. That's going up. S&P's going down. I see this continuing, even though we might get short-term reprieve here or there. Be careful. I think we're going lower. All right, let's go back now to the other screen that I had. I want to just go into earnings spotlight very quickly. Not really any big companies coming out with earnings. One company, Olaplex, reported the stock was up about 10% or 11% pre-market, I saw, but it was down 11% yesterday. So all it's doing is getting back basically what it lost yesterday. Still in a downtrend, underperforming. I would be careful. Another company that reported, Dick's Sporting Goods. I think this one was up a little bit pre-market, I believe. But it too is rolling over to the downside unless we can get back through 110 and really ultimately 120. I think this one goes lower. So I would be careful. Final thing, 3 you must see. And I'll tell you, sometimes you think you have safety and you don't. Look at Fortinet, FTNT, down $44 yesterday. AD line looked good. It's one of the strongest software stocks out there. Yesterday took a tumble. How about LYV? This is a stock that I thought with the Omicron, the virus, COVID going away this year, maybe this is a reopening stock that would do well. It looked really good a week ago. And now the stock's lost 25% or 20% in just a little over a week, now testing major support down at 100. The last one, Wynn Resorts. Kramer came out recently pounding the table on these gambling stocks. Well, Wynn Resorts just broke down and the volume increasing. Got to be really careful with this stock as well. Anyway, that's it for me. Please be careful out there. I'll be back on Wednesday morning over at Earnings Beats for your next Trading Places Live. Take care, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.